Welcome, welcome, welcome to Accounting 101. Dr. Donna Varis here. This is week 4, lecture 3. And today's topic, one of my favorites, really excited. But let's wake up the brain and do a quick refresher on the things that we've covered. So we've discussed the definition of what accounting is, right? We did the two types of accounting, the two main types of accounting. We discussed the importance of having a budget and understanding the different types of expenses that are out there. And last week, you guys, we discussed what the 4 main types of business entities that are there, and your online discussion last week was contingent on that. Well done, well done, well done. Quick note for those students who are always posting late, it will have a dire impact on your overall grade. This is the last time I will be making mention of it, that you need to post your initial post by the end of the 4th day of the week, okay? All right, so let's get started. All right, let's take accounting out of this and wake up your brain, right? Let's use CityTech. Now, if there was no laws or guidelines regarding cheating or plagiarism, which is another form of cheating, what do you think students would do if there's no repercussion to it? Be honest. Oh my God, I just remember Dr. Boris's assignment and I didn't do it. Let me just Wikipedia the situation, copy and paste it. I won't even have a thought or put any input on it as my own. I am just going to copy and paste somebody else's work or borrow my friend's work or have somebody else do it and submit it because there's no repercussions to it, right? No different in accounting. So without regulatory standards, we can say companies would be free to present their financial information in whatever format that best suits them. You would say that, right? No different than cheating. If there was no repercussions to cheating, people would cheat. No different with companies. If there were no regulatory laws and standards, company would do whatever works best for them. All right, which brings us to today's topic. We're going to go back all the way to 1929. What are we doing 100 years in the past? Because the past is prologue, and you're going to see how similar it might sound to 2020. But 1929, before 1929, what was going on? America was booming. People were making money hand over fist. We had multimillionaires overnight and millionaires and people with great ideas and anyone and everyone that could just live the American dream. And it was the industrial period where everybody was making stuff, making money, and just winning, all right? But there was little guidelines or guardrails that was going on. So in 1929, does anybody know what happened? The stock market went kaboom. It crashed. Wait, what do you mean the stock market crashed? The stock market crashed because people were just, I guess, earning a dime, but saying that they were making a dollar, but they were spending a dollar, or however, whatever they were doing in regards to presenting what wasn't. And so the public was just investing because, ooh, this seems good. Let me just put my money in this bank. Come to my bank, I will give you 10%. And anything and everything you want. There was no guidelines and guardrails. And so in 1929, the stock market crashed and everything went crazy. People started to lose their job because when the stock market crashed, companies have to do layoffs. When the companies do layoffs, the people who just got laid off not spending money. If the people who just got laid off are not spending money, the companies can't make money. And if the company can't make money, they have to lay more people off. And if more people get laid off, they're going to keep on hoarding more money. And so the cycle became now, which lead into the Great Depression. So the depression is multiple consecutive recessions. And the 1929 stock market crashed evoked the Great Depression. And really, for those who are history buff and even accounting accounting majors, definitely read up on the Great Depression and see how similar it looks to today. So the Great Depression. So the 1929 Great Depression now caused a lot of hardship. And the government now had to step in to inject some form of confidence because me as the average layman, I'm not spending any money because I don't know what is going on. All these companies are laying people off. I am not spending money. I'm not putting my money in the bank. I'm hiding it under my bed. I'm burying it in my backyard, whatever it is. But if people are not spending, company can't make money. If company can't make money, people get laid off. If people get laid off, so it was just a cyclical thing where everyone was nervous. And when it was nervous, the government now had to step in and inject some form of confidence into the economy. And one of the ways that the government wanted to inject confidence in the economy was to actually now create some form of guidelines and guardrails. Because the reason why the Great Depression happened, one of the main reasons, were there were little or no regulatory standards towards the companies. They could operate any and every way. And when you don't have any guidelines or guardrails, people are going to misbehave. And remember, we discussed that corporations are like people. And if people can misbehave, corporations are going to misbehave. And misbehave they did. So the government had to step in. So the government asked the American Institution of Accountants to come up with the best guidelines and guardrails in regards to how companies should behave. So they gathered them all together, and in 1933 they created the Securities and Exchange Act, which was mostly some think about it, it's almost like some laws in regards to how corporations should behave. And one of the things that the Securities and Exchange Act of 1933 gave birth to was the Securities and Exchange Commission of 1934. So what is the SEC? Oh, the SEC is the police of all things that are corporations. So the American Institute of Accounting, which eventually turned into the Financial Accounting Standard Board, or FASB, they then gathered all the top accountants in the country at the time and came up with some guidelines and guardrails in how companies should behave, which gave birth to the GAAP principles. So FASB, the Financial Accounting Standard Board, created GAAP, which is GAAP, General Accepted Accounting Principles. So I like to think about it almost like this. So the GAAP principles are the laws. The FASB are the ones that created the laws because they are made up of accountants, so they are the experts. They're the subject matter experts of it. And the Securities and Exchange Commission, they are the police that enforces the law. So it's a lot of things, but let me give an example to it. So let's say we are speeding along Atlantic Avenue, right? Now, the actual writing that says you can't go past 30 miles an hour on Atlantic Avenue, that law is the GAAP principle. So you cannot go past 30 miles an hour on Atlantic Avenue. That is the law. The person who wrote the law would be FASB, the Financial Accounting Standard Board, because they go out and they determined, based on all of our research as a subject matter expert, 30 miles an hour is the safest on Atlantic Avenue. So FASB creates that law, right? Now the Securities and Exchange Commission, they are the police. So if you break the law, then the SEC steps in, right? So it's a lot of acronyms, but I always encourage students, think about it almost like speeding. So someone had to write the speeding law, right? You have the actual law itself and who enforces the law when and if the company breaks it. So we have the Securities and Exchange Commission, who is the police of the public companies. You have the Financial Accounting Standard Board, they are the ones that are made up of accountants and subject matter experts that writes the law and adjusts the laws accordingly. And then you have the law in itself, which are the GAAP principles, which are the general accepted accounting principles or standards, right? So with the FASB, you also have GASB, which is a government accounted standard board, and those are more laws for governmental and municipals, but we don't really want to touch them. But you have FASB, you have GASB, you have GAAP, and you have SEC. It's a lot, but for this class, you want to focus on the SEC, you want to focus on FASB, and you want to focus on GAAP. So the 10 principles of GAAP. What do they do? Why do they do them? We're going to get into those 10 principles right now. Or one of the GAAP principles, the first one, it simply states that the business is a separate entity in the eyes of the law. It never dies in the eyes of the law, and if you have any problems or any litigations or any lawsuits or liabilities, it's separate from the owners. So that's the first GAAP principles, that the business is a single entity concept. So the business is a single entity concept. So principle 2. So we have the specific currency principle. And what this means is, even though you have corporations that are international, all of their financial statements have to be in one currency, and that makes sense. So even though you might have a branch in Canada or in Europe, when you are doing your yearly financial statements, it has to be in US dollars if you're a US company. So you might have the Canadian branch might do a version in Canadian dollars, but for clarity's sake, for the specific currency principle, it states that all their financial statements should be in one currency. And that makes sense, right? The third one is the specific time period principle. And basically what this is saying is that the financial statements should always be specific to a certain time. So you should always, and later on when you get an assignment in regards to pulling up a company's 10K or their financial documents, you can clearly see what time period it is dealing with. And if you're looking at a benchmark versus LY, it would have to be the same. So all of these might seem like they're common sense, but remember we just discussed the reason why the Great Depression happened, because companies were presented their financial information in whatever way that best suits them. So that's why you needed guidelines and guardrails to say, no. With a specific time period principle, you have to have your financial statements in a specific date, and the balance sheet, which is a snapshot of the overall health of the organization, has to be by a certain date. So it has to have a cutoff. An example is your credit card. So your credit card always have to come at a specific date. They can't just send it to you when you feel like. It has to be a specific cutoff date that is always the same. They can't just pull a fast one on you, and that's because of the law. All right? So the fourth GAAP principle is the historic cost principle. And the historic cost principles are basically said that any item, historical cost must be used for value in an item. So I'll give you a perfect example. I didn't even realize I was wearing Chanel, darling. So let's say this was my great-great-grandma's pearl, and it is extremely expensive, but the value that it is present value today is going to be significantly higher than what my great-grandma paid for it. But let's say we're an organization now. If I want to use the present value for a couture piece, then it would inflate my financial statements, because how much I paid for it, the cost that I paid for it, is not the value that it is today. You try to pull a fast one on me. So this is why the GAP principle says for the historical cost principle, you have to use historical value, historical cost for valuing items. So whatever I paid for it, or my great grandma paid for it, as a corporation, that's the cost that I have to put on it, not how much it's worth today. All right. Now the fifth one is the full disclosure. So the full disclosure principles basically says that with all the scandals that are happening nowadays, companies must reveal every aspect of what is going on their financial statements. And again, when you get your homework, you'll see sometimes they have little asterisks that are there. This is why you have to disclose what is happening. And the GAP principles are going to be that common thread throughout, where you're going to always see that we're going to refer back to the GAP principles. So the full disclosure, you'll be like, yeah, that makes sense. You have to disclose everything that is going on, because when we do the Enron scandal, you'll see that people that are making 30, 40, 50 million dollars was like, I don't know, it wasn't me, I didn't know. And so the GAP principles and the laws are saying that you have to disclose everything that is going on pertaining to the financial activities when you present your financial statements. The recognition principle is number 6, and the recognition principle says their incomes and their expenditures. Wait, didn't we just discuss incomes and expenditures for your budgeting? Your income and your expenditures must be in the same time which they occur. Again, you can't just say, oh, I am going to get money. Again, when you do scandals, specifically the Enron scandals, you're going to see people like to claim money that they haven't even gotten yet as on their statement. No. Your income and your expenditures must be recorded in the same time period that they occur. The non-death principle of the business, and number 7 almost ties back to number 1. Since the corporation in the eyes of the law is a legal separate entity, it never dies. So the 7th one says it never dies. There's no end date to it because it's separate in the eyes of the law. The corporation never dies. All right. Now, number 8 is the matching principle, and the matching principle says, in layman term, for every debit, you must have a credit. And this is going to be everything when we get to journal entries. So get your pen out, circle it, underline it. For every debit, you must have a corresponding credit. For every yin, there must be a yang. For every out, there must be an in. So that is the great thing about accounting. If you sum it up in one thing, the 8th principle, which is the matching principle, it basically says the accrual accounting standard says for every debit there must be a credit, for every credit there must be a debit. All right. Number 9, the principles of materiality, and this basically says when you're working with large numbers, understandable, there will be sometimes little differences that adds up. So if I ask you, how much money you have in your pocket, you might say, I have around $10-ish. So if I count it up, and let's say I'm the SEC and I'm like, empty your pocket, and I count it up and you have $10.20, I'm not going to say, you are lying to me, you're trying to disguise and discard, and you're trying to trick me. It's immaterial. That 20 cents is immaterial in regards to it. And really that is what the principles of materiality is saying, that you have to still use your judgment, because sometimes you have bookkeepers, you have people on the inside doing financial documents for the outside. Certain little things might happen where the actual adding up might not match perfectly, but you have to have a standard, what you consider that is inconsequential, right? So that is what the principles of materiality basically says. that nobody's perfect, and the SEC understands this and know that sometimes there will be small variances, very small variances in regards to what they say they have. That is, all right. The 10th principle says the principles of conservative accounting. So principles of conservative accounting, it sounds like what it is. That's saying that accountants should always be be a little bit more conservative, and you should always be more adaptable for what's the best interest of the company, and it's better to be safe than sorry. So let's take that same example. If you're not sure, you're like, do I have like $10.20 or do I have $9.20? It's always better to be on the safe side. That is what the principles of conservative accounting is basically saying, that when expense happens, you should record it immediately because you've incurred an expense. Just record it that I owe you. But when revenues are coming in, hold your horses. Let's wait till the money is actually in my hand, because things can happen. And that is actually one of the ways when we're doing bad debt and bad debt reconciliations, you'll see what we mean. When you incur an expense, record it immediately because you have an expense. But if you have revenue that are coming in that haven't gotten yet, don't count your eggs, don't count your chickens yet. One of the big things that we want to also discuss eventually is the limitations of GAAP, and that even in today's standard that there are some holes with GAAP. So let's step back and let's discuss. So 1929, the Great Depression happened. People lost confidence in the government and in the industry, so the government had to step in to inject some form of confidence. They now asked the American Institute of Accounting if they could create some guidelines and guardrails so companies don't misbehave. The American Institute of Accounting created the Securities and Exchange Act of 1933, and then the SEC, the Securities and Exchange Commission, which was created in 1934. They are the police. The American Institute of Accounting eventually turned into the Financial Accounting Standard Board, and what FASB does, they are the ones that write and maintain and adjust and alter the guidelines and the principles that used to govern companies. The main one that was out there for the last 50 or 60 years was the GAAP principles, and the GAAP principles are the ones that are the actual laws. If a company steps outside the GAAP principles, then the SEC comes in and injects it. So definitely do some research on the SEC, the GAAP principles, FASB, GASB. You also have the International Standard Board, which is more for international companies, but for FASB, it's focused on companies within the United States. And your online discussion will be focused on this topic. So happy reading, and I will see you on the other side of life.